12 ways to reduce risk in your stock investment portfolio. Investing is a way to let your hard-earned money do some of the hard work for you. This sounds great on paper, but in reality, investing comes with a degree of risk, and investors must decide whether the trade-off between the level of risk and potential return is worth it. If the thought of potentially losing the capital you put into your investment scares you, don't boycott all your investment ideas just yet. The good news is there's plenty of ways to minimize the level of risk you take on when investing. In this episode, we'll walk you through 12 ways to reduce risk in your stock investment portfolio. But before we get started, don't forget to hit that subscribe button so you don't miss the future episodes about investing in stocks. 1. Adopt dollar cost averaging. The term dollar cost averaging refers to the practice of investing a consistent dollar amount in the same investment over a period of time. For instance, you might be interested in buying XYZ stock but don't want to take the risk of putting in all your money all at once. You can instead invest a steady amount, say $300 every month. If the stock trades at $10 one month, you'll buy 30 shares. If it later goes up to $12, you'll end up with 25 shares that month. And if the price falls to $8 another month, you'll accumulate 37 shares. One advantage to dollar cost averaging is that by investing mechanically, you'll take the emotional component out of your decision making. You'll continue on a preset course of buying a certain dollar amount of your preferred investment, irrespective of how widely the price swings. This way, you will not bail out of your investment when the price goes down in a wild swing, but rather see it as an opportunity to acquire more shares at a lower cost. 2. Index funds. Passive investors invest for the long haul. Passive investors limit the amount of buying and selling within their portfolios, making this a very cost-effective way to invest. The strategy requires a buy and hold mentality. That means resisting the temptation to react or anticipate the stock market's every next move. The prime example of a passive approach is to buy an index fund that follows one of the major indices like the S&P 500 or Dow Jones Industrial Average, DJIA. Whenever these indices switch up their constituents, the index funds that follow them automatically switch up their holdings by selling that stock that's leaving and buying the stock that's becoming part of the index. This is why it's such a big deal when a company becomes big enough to be included in one of the major indices. It guarantees that the stock will become a core holding in thousands of major funds. When you own tiny pieces of thousands of stocks, you earn your return simply by participating in the upward trajectory of corporate profits over time via the overall stock market. Successful passive investors keep their eye on the prize and ignore short-term setbacks, even sharp downturns. 3. Diversify your investment portfolio across market caps. The simplest and most straightforward way to reduce risk is to spread out investments into more companies, asset classes, and investment types. Essentially, this would be an example of not putting all of one's eggs into the same basket. For example, you might consider having a mix of large cap, medium, and small stocks. You might also have some bonds in your portfolio. You can even spread out your stocks by industry, e.g. conglomerate, healthcare, tech, etc. You can also add some international stocks into the mix and even break those down by risk. For example, invest in Europe, China, India, emerging markets, etc. Do your research and find the best diversification plan for you. Stick with something simple. Don't overthink it. 4. Diversify across regions. Just as investors can spread risk across different market caps, they can also spread it across different geographic regions and countries. US and European markets, as advanced economies, tend not to grow as quickly as emerging markets. Emerging markets such as Brazil or Vietnam have room for fast growth, as their economies strive to catch up with the likes of Japan and the US. However, they can also collapse quickly due to political instability or economic crises. As with market caps, you can balance risk and growth by spreading money across funds operating in multiple regions. Aim for 50% US funds and 50% international funds, but there is no magic rule for success. In general, the less developed the economies in the regions where you invest, the greater potential there is for growth, and the greater the risk of fast losses. 5. Diversification across sector. One of the most important principles of investing is to ensure that you have a diversified portfolio. This means ensuring that you spread your capital across different sectors and industries so that you're not reliant upon a single sector or industry for all of your returns. The key benefit of diversification is that it helps to minimize risk of capital loss to your investment portfolio. If one sector performs poorly over a certain period, other investments may perform better over that same period, reducing the potential losses of your investment portfolio from concentrating all your capital under one sector. 6. Buy REITs. REITs, Real Estate Investment Trust, offers investors the benefits of commercial real estate investment along with the advantages of investing in a publicly traded stock. The investment characteristics of income-producing real estate has provided REIT investors with historically competitive long-term rates of return that complement the returns from other stocks and from bonds. REITs are required to distribute at least 90% of their taxable income to shareholders annually in the form of dividends. Significantly higher on average than other equities, the industry's dividend yields historically have produced a steady stream of income through a variety of market conditions. In addition to the historical investment performance and portfolio diversification benefits available from investing in REITs, REITs offer several advantages typically not found in companies across other industries. These benefits are part of the reason that REITs have become increasingly popular with investors over the past several decades. 7. Invest in bond funds. A bond fund invests primarily in a portfolio of fixed income securities. Bond funds provide instant diversification for investors for a low required minimum investment. Due to the inverse relationship between interest rates and bond prices, a long-term bond has greater interest rate risk than a short-term bond. So, invest in bond funds to help you manage risk. 8. Only speculate with money you can afford to lose. The word speculate is explained in the dictionary as consider, form opinions, guess, buy and sell goods, stocks and shares, etc. with risk of loss and hope of profit through changes in the market value. Speculation is exciting. It's here to stay. However, all speculators are not successful. Several lose fortunes. You should use money that you can spare, money you can afford to lose. For instance, if you use the money you save to buy a house or a car, then you will be under a lot of pressure to make a profit or to sell the shares if they begin to fall. Only if the speculator can afford to lose the money will he have the mental independence to take risks. 9. Reinvest dividends. A dividend is a reward, usually cash, that a company or fund gives to its shareholders on a per-share basis. When a stock or fund you own pays dividends, you can pocket the cash and use it as you would any other income. Or you can reinvest the dividends to buy more shares. Though having a little extra cash on hand may be appealing, reinvesting your dividends can really pay off in the long run. It's also a great way to reduce risk with your investment portfolio. 10. Make defensive moves before a crash. If you begin to lose sleep because it's imminent the market is crashing, you should make defensive moves before a crash. You should never let your emotions control your investment decision making because that will cause you to make mistakes that a cooler state of mind could have picked up upon. 11. Think twice before selling during corrections. A key risk to your investment portfolio is that due to a financial emergency, you might need to redeem investments during corrections or market downturn. This risk can be significantly reduced by taking your time to analyze your situation before selling. 12. Hire an expert occasionally. Financial advisors can provide investors some good advice about what kind of investment goal they should have in mind, as well as what kind of investments they should be making in light of their investment goal. However, it's best to hire financial advisors occasionally for multiple perspectives. This will help you to tap into their knowledge. You will also gather useful information to keep your investment risk-free. As every investment you make comes with some risk, it's not possible to create an investment portfolio that optimizes returns, ensures zero risk, and at the same time achieves your financial objectives. That said, implementing the 12 tips mentioned above can definitely help you find the appropriate balance between risk and return so that your investments continue to grow over the long term and help you achieve your financial goals. That's it for this episode. Please give us your feedback in the comment section below. To watch more episodes on financial topics like this, hit that like and subscribe button. If you want to support us even more, buy us a coffee from the link in the description. Good luck and see you in the next episode.